There's a big difference between claims made and occurrence forms and how they react in the insurance environment. An occurrence form allows you to report a claim even if you've given up the insurance policy. It allows an extended reporting period whereby even if you're not insured anymore, you've sold your company, you've retired, you don't have that policy anymore, you can still go back and submit a claim as long as the trigger of the claim happened during the period that you had on your occurrence form. Claims made works differently. Claims made stops and has a very short reporting period inside of it, inside of the insuring agreement. So if you have a claims made form, and let's say you decide that you found a better policy with better coverage and better pricing, but it's occurrence. You want to make that switch. It's a big business advantage for you. You get into the occurrence form, now there is going to be a gap because of that extended reporting period on the claims made form. Typically it's 0 to 60 days. Let's say that you are in a claims made form and you have the trigger to the claims made form is running January 1st to December 31st. And on December 1st, you get involved in the trigger of a claim. You give up the policy on December 31st, you don't have it anymore, you get into an occurrence form. Occurrence form runs the next year, January 1st to December 31st. Does that part make sense? Okay. So the trigger of this claim, you don't find out about it until June the next year. You can't claim it on the claims made form because that 60-day reporting period has already lapsed. You only had till March 1st to claim it. So throw it away, it's not going to cover it. You're in the occurrence form. But the trigger to the claim happened when you were in the claims made form. So the occurrence form isn't going to pick it up. It's a new policy and it won't go back unless you've made arrangements to make that happen. So when you're in a claims made form, it kind of, to a certain degree, locks you in. Now you can buy extended reporting periods. You can buy an extra year or extra 2-year or 3-year. They actually have unlimited extended reporting periods. But they're 200% of what you're paying for premium. So you're really going to pay a high dollar amount to get the coverage you need and to bridge that gap. Best advice I can give you is talk to your broker at length about which form, which they suggest, and why. And make sure if you're switching from one form to another that you know what the negatives are about doing that.